Shaurya Kumar, you are from Telangana. What is the
Yes, sir.
degree you have studied?
Actually, I've completed my BTech in 2016 in
Acha.
Computer Science of Engineering.
And after that, were you preparing for IAS exams and all?
No, sir. Actually, I've worked for MNC for 4 years. After
Oh,
that, I quit the job, and
hmm,
2021 I started preparing for the bank exams.
very
So
good.
from
Yeah.
then on,
Yeah, I'm happy that you could come to know of this news. In fact, I was not aware that small finance banks are not covered by prompt corrective
that,
action. So you have got this material. I am thankful to you. Now, I request you to read this. What is PCA? Please read it. Are you seeing on the screen? Is it shared with you?
yes, sir.
Please read.
Yes, sir. What is PCA? PCA is full form as Prompt Corrective Action, is a framework under which banks with weak financial metrics are put under watch by the Reserve Bank of India. The Reserve Bank of India introduced the PCA framework in 2002 as a structured early intervention mechanism for banks that became uncapitalized due to poor asset quality or vulnerable due to loss of profitability. A,
Undercapitalized.
yes,
Undercapitalized.
undercut. Yes,
Ah, continue.
it aims yes, it aims to check the problem of non-performing assets in the Indian banking sector. The framework was reviewed in 2017 based on the recommendations of the Working Group of Financial Stability and Development Council on resolution regimes for financial institutions in India and the Financial Sector Legislative Reforms Commission. PCA is intended to help alert the regulator as well as investors and depositors if a bank is heading for a trouble. The idea is to head off problems before they attain crisis portion. Revised framework applicability. The PCA framework was earlier applicable only to commercial banks. The revised framework applies to all banks operating in India, including foreign banks operating through branches or subsidiaries based on the breach of risk thresholds of identified indicators. However, payment banks and small finance banks has been removed from the list of lenders where corrective action can be initiated. The new provisions were applicable from January 2022. Monitored areas, capital, asset quality, and capital to risk weighted assets ratio (CRAR) and NPA ratio. Tier 1 leverage ratio will be the key areas for monitoring the revised framework. However, the revised framework excludes return on assets as a parameter that may trigger action under the framework. Invocation of PCA. The breach of any risk threshold may result in the invocation of PCA. Stressed banks may not be allowed to expand credit or investment portfolios. However, they are allowed to invest in government securities, other high quality liquid investments. In the case of a default on the part of a bank in meeting the obligations to its depositors, possible resolution processes may be resorted to without reference to the PCA matrix. What is a non-performing asset? Non-performing asset is a loan or advance for which the principal or interest payment remains underdue for a period of 90
Oh,
days.
hello, overdue.
Overdue, overdue for a period of 90 days. Banks are required to classify NPA further into substandard, doubtful, and loss asset. What is capital adequacy ratio? CAR? CAR is a measure of bank's available capital expressed as a percentage of bank's risk-weighted credit exposures. The capital adequacy ratio, also known as capital to risk-weighted asset ratio, is used to protect depositors and promote the stability and efficiency of the financial systems around the world. What is Tier 1 leverage ratio? It is a relationship between a banking organization's core capital and its total assets. The Tier 1 leverage ratio is calculated by dividing Tier 1 capital by a bank's average total consolidated assets and the certain off-balance sheet exposure. A leverage ratio is any one of several financial measurements that assess the ability of a company to meet its financial obligations. Some of the examples are equity ratio, debit to equity ratio,
Debt
equity
ratio.
debt ratio. Equity ratio. The ratio indicates total owner contribution in the company. Debt ratio. This ratio indicates total leverage used in the company. Debt to equity ratio. This ratio indicates total debt used in the business in comparison to equity. What is the role of RBI in PCA framework? In governance related actions, the RBI can supersede the board under Section 36A CA of Banking Regulation Act 1949. Amendment to Section 45 of the Banking Regulation Act enables the Reserve Bank to reconstruct or amalgamate a bank with or without implementing a moratorium with the approval of central government. The RBI, as part of its mandatory and discretionary actions, may also impose appropriate restrictions on capital expenditure other than for technological upgradation within board approved limits under the revised PCA. What are the challenges and issues regarding PCA? PCA is an exceptional action and impacts the rate of the bank as well as customer confidence. This is
Consumer
the
conf consumer
consu-
confidence.
uh, consumer confidence. This is detrimental in the long run as it impacts the credit history of the bank and raises questions about its management. PCI can accelerate the loss of market share and cause further decline of the position of the public sector banks in the financial system in favor of private banks and foreign banks. PCI is seen by the government as a hindering economic growth, therefore is arguing for easier lending policies by relaxing the PCA norms and aligning the
Align,
aligning the
aligning
aligning,
them.
sorry, aligning them to global norms. The tussle between RBI and government can negatively impact the image of India as an investment destination. What can be the way forward? Narsimhan Committee in 1998 on structural reforms recommended the mergers of Indian banks. A consolidated banking industry will be able to better deal with NPA crisis. Government should address the core issue of governance impacting the banking sector. A formal agency such as Public Sector Asset Rehabilitation Agency can be instituted to resolve the large bad debt cases. This step was taken by the East Asian countries after they were hit by severe twin balance sheet problems in 1990s. The Insolvency and Bankruptcy Code mechanism needs to be strengthened to meet global standards with active involvement of the government, regulators, lenders, borrowers, and the judiciary.
That's all.
That's all.
Very good. Thank you.
Thank you.
Thank,
Thank you,
thank
sir.
you so much. It was good that you wrote